Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
Happy holidays and welcome to the December episode of Cup of Joe. We're so glad you're with us. As always, my name is Mike Carrozzo and I'm joined by Saint Nick Webb. How are you?
I appreciate that. I'm doing great. You look wonderful in that hat today.
Thank you. I got kind of half Hanukkah blue, half red Christmas, or it could be Ryerson blue, red
Yeah.
Christmas, whatnot. But hey, can't outdo you, man. Look at that. I mean, you are a full jolly. I
Got
love it.
Santa rocking the shades, got the
Love it.
leg lamp on the blazer.
There's a
But
leg lamp on it.
there's a leg lamp on there. Yep. Right here. I don't know if viewers can see it, but down kind of
Beautiful.
low. Yeah,
Oh,
yeah.
that's great.
So yeah, we've got the whole Chris Mahana Kwanzaa aspect covered.
Nice. Beautiful.
Yeah.
Well, I'm gonna speak for you and say it's our favorite show of the year
Oh,
because
absolutely.
yeah, we're gonna get into market updates, but it's kind of colored around um where Nick's hits and misses, right? Your scorecard for the year back in January or it was February.
It was
You
early
made
February. Yep.
Yep. You made five predictions about the metals market or the market in general. So
Yep.
we'd like to go back at the end of each year, have a little bit of fun about where you got it right, where you got it wrong, and then kind of paint that in the context of the market.
I think you said
Um,
exactly right. And I'm going to be pretty hard on myself today.
oh yeah, okay, yeah.
Yeah.
It was a tough year, man. I mean, you didn't know. I mean, things really changed a month later. The
Oh
world
yeah.
just spun on its ear
Yeah,
afterwards.
absolutely
So
true.
we'll grade you on a curve this year. How's that?
That's perfect.
Before we get into it, little wanna talk about the next two episodes of Cup of Joe. So typically we're the first Thursday of every month, right? In January, it's January 1st, I think is or the first Thursday is January 1st. So I don't know about you, but we'll wait a week to get into the doom and gloom that Nick brings us for the new year. So we're gonna do it January 8th instead. But then our February, a little gift for our viewers, we have a 90-minute episode on February 5th, where Nick and I will be joined by three of our supply chain directors to go
Absolutely.
into our preview of the year. So
Excellent.
bookmark those. All right. Well, without further ado, let's get into it.
As Mike had mentioned, before we get into those, we're going to cover the safe harbor provision. These are the opinions of Nick Webb, Mike Carrozzo, not the opinions of Ryerson. Do your own research. But what we're going to be covering here today are the five predictions that I made earlier in 2025. And we're going to review whether or not I think I was accurate, spot on, or completely off the mark on these. We'll go through each one of them, as Mike had mentioned, woven within kind of whether or not we were right or not. We're going to give some more context, some more color around each of these categories and kind of give you a deeper look into how we're viewing markets at the moment. And, as Mike had mentioned, here over the next 45, 60 days, I'm going to be shaping my thoughts around forecasting for 2026, hopefully come up with five excellent predictions for 2026, but surely I'm going to be wrong on a few of them. As I was in 2025, little preview there. So the
Nick,
first one was, yeah,
Nick, sorry, I should mention I tend to do this. I've not mentioned it the past few shows, but you have questions for Nick along the way, drop it in the Q&A button at the bottom, and we'll be
yep,
happy to get to them along the way.
yep, perfect.
Go ahead.
So the first prediction was that we were going to see a reversion of the old economy versus the new economy. What does that mean? My prediction was essentially looking at the stock market and saying things like technology, things like communication services, things that for the last 3 or 4 years have just been booming. And some of these companies are growing to multi-trillion-dollar companies and sort of leaving this giant bifurcation between what I'm calling the old economy, which would be things like manufacturing, like energy markets. And my prediction at the beginning of the year was that we were going to see a mean reversion, basically the technology stocks coming back down to earth while the other ones, the old economy, outperformed. Well,
Hey, Nick, I'm sorry, I'm gonna speed bump you again.
yeah,
Good point from one of our listeners. You have your Zoom bar open at the bottom. Would you mind hiding that? Because I think it hides some
Sure.
of the data.
I,
We're
I
not technical wonders.
sincerely apologize to all of our viewers. My goodness. These things happen on live broadcasts. But I will readily admit that I was not only wrong on how I share my screen, but I'm also wrong on calling out the technology sector. What's interesting about this chart, and I know it's a very busy one, but I tried to do my best of highlighting over in the top left corner the legend of what we're looking at here. But ultimately, these are the different ETFs, the primary I'd say sub indices of the market. You've got things like technology, communication services, energy, materials, industrials. I'm not going to go through all of them. But what was interesting was earlier in the year, let's say about 40 to 60 days after we made these predictions, we got Liberation Day. And what was interesting was technology stocks, which you can see in the white line here in this chart, they were actually the ones that got beaten up the most. So if we just took a snapshot as of April and Liberation Day, when we had chaos in the markets, technology stocks were actually the worst performing names within the space. Fast forward to where we are now, obviously Liberation Day kind of got walked back a little bit. We got some interest rate cuts and we got a lot of exuberance within the markets and most specifically within big tech stocks. So even though they were the worst performing names back in, let's say, late March, early April, we finished the year with technology stocks up about 24, 25%, which is a massive gain over the course of the year. That being said, when you look at some of these other categories, things like financials, utilities, healthcare, industrials, they certainly didn't slouch. So I am still going to say I'm wrong on this one, but industrials, 17% on the year, that's pretty darn good performance. That's certainly a better performance than what the stock market typically awards. So, there's a little bit of a caveat on saying that I'm wrong because some of the, we did have a situation where many of these ETFs did actually perform quite well over the course of the year. Have a very accommodative Fed over the last several months, and I think that's certainly fueled a little bit of that.
I think at the beginning of the year, right, the thought was, right, and this is before tariffs went in place, but the idea was tariffs come in, bringing some industry back into the United States, right? So a little bit of the old economy performed well, and the expectation was maybe some of the services or tech stocks would take a step backward. So I kind of see where you're coming from on that one, and I think it's kind of a push, right? I don't think it was right or wrong. That's kind of where I would put you on this one.
You're being very kind on that, but
Yeah.
like I said, I'm going to be tough on myself, and there's no doubt
Yeah.
about it. If you were in the technology ETFs, any of the big technology names, your performance would have been better than in other categories. And that's just looking at it from a stock market. That's not necessarily saying that the economy in all of these sectors did phenomenally well, because as we've pointed out throughout the course of the year, this chart's pretty similar to the type of phenomenon that we saw for much of 2025, which was, at least within the industrials world and the manufacturing world, it really has been a tale of the haves and the have-nots. And it does depend on which sector of that manufacturing economy you reside in, whether or not you had, a decent year, a very flat year, or potentially an abysmal year. And you can see that pretty well represented here within this chart, that things that are related to construction machinery, things that are in aerospace and defense, HVAC, those markets are doing extremely well. Many of them are kind of AI data center tangential. And I think that tailwind is likely going to continue into 2026 based on some of the things we're hearing. But you go over to the right-hand side and you've got markets like the ag equipment just, sucking wind. And I would say that's really for a couple of years running at this point. Residential construction, mining, and energy, those are some of the softer spots of the economy. So again, there is this divergence taking place underneath the scenes within the manufacturing space.
That's a great point, right? Because the industrial, the old ones that are coming back, tied to data center construction and all that, right? It's for lack of a better term, temporary, right? I mean, the idea is like get sustainable industry back, agriculture, things like that. So, maybe you were wrong. Sorry.
Yeah, and I think that's fair. And I think there's a healthy economy is one where kind of everybody's brought along with it. And right now, I would make the argument that really hasn't been happening for the last 2 years. We've talked about that in prior Cup of Joes, just a hyper-scaled, hyper-concentrated economy. And I think it would be a good thing if we can get kind of more of the end markets on board with that growth. And hopefully that's to come in 2026. We'll see if that's going to be one of the predictions. One other place where we're seeing some, I talk about this reversion to the mean or reversion to typical norms. This is just one that I found interesting. I was doing a little bit of this data analysis over the last couple of days, looking at the price of gold relative to the price of oil. Obviously, both of them are commodities, but what they represent are kind of different things, where gold can be sort of a safe haven asset. People may flock to gold when things get scary. They may flock to gold when they think inflation is going to run away, or when maybe a government's overprinting or overspending. People may flock to gold. Whereas oil, I would argue, is more of an industrial type commodity. It's one that is kind of representative of that old economy. And what's fascinating is going all the way back to as far back as I could get the data, the gold to oil ratio has basically blown out to the widest levels we've ever seen, with only one exception, which was when we had COVID lockdowns and oil actually went negative. So I almost throw that one out because that was more of a fabricated type market phenomenon. But if you throw that out, we are exceptionally at all-time highs, which I would call this trade, one where a lot of traders are kind of saying that the Fed is maybe not losing control, but certainly that the U.S. government is spending a fair amount of money. We're running budget deficits, and for that reason, we're seeing gold really outpacing oil, which would be more representative of kind of that old school manufacturing economy. So, this is one, I know we're at the very end of this, we're going to talk about a wish list for 2026. This would be one that I think, again, would be healthy if we could see this relationship come back down to earth to more of a historical range. All right, second prediction. This one's pretty simple. So I predicted that in 2025, we were going to see higher volatility as measured by the VIX, or volatility index. This one's pretty straightforward. I basically just took a snapshot of 2024 on the left-hand side, snapshot of 2025 on the right-hand side, and looked at both the average of where the VIX traded as well as where it maxed out. And in both situations, 2025 was a more volatile year. It was more consistently volatile. And I don't think the reasons why should be any real surprise. We've certainly had some geopolitical turbulence. We've certainly had the Truth Social, Twitter, X turbulence coming by way of just new headlines, Liberation Day. All of those trade-related factors just caused massive volatility within markets. And this is showing volatility of specifically the equity markets. But I would certainly make the argument that we've seen it within commodities as well. One, perhaps no better place, would be within the copper market, where particularly in the case of COMEX copper, you can see so that's going to be the white line shown in this chart, massive volatility, where there was an expectation we were going to have tariffs put on copper cathodes, and then all of a sudden they got exemptions. You can see that taking place in late July. We saw the price of copper drop about 23% in a matter of hours. And fast forward to where we are now, both COMEX copper and London Metal Exchange copper are trading within sniffing distance of all-time highs. In the case of London Metal Exchange, it is in fact all-time high prices. So copper is a market that remains tight. We've talked ad nauseum about the fact that Indonesia has the Grasberg, so it's Freeport-McMoRan is the company. Their Grasberg mine, which represents about 3 to 4% of global supply, is expected to be down due to basically a mudslide for most of 2026. So in the face of this burgeoning and maybe exploding AI market, data center market, the need to build out electrical grids, any supply coming offline is going to exacerbate that tightness. And we're certainly seeing that within price right now. And then another spot within the commodity space where we're seeing volatility is natural gas. Similar story here, where you do have the need for data centers, the need for compute, the need for electricity. That's certainly a factor on the demand side, but also here in the last 2 weeks, at least for those living up in the northern part of the United States, we're experiencing a pretty big snap of cold, and it's expected. I'm seeing a lot of forecasts saying it's going to be expected to remain for much of the winter season. So when that happens, you obviously get tighter natural gas markets, tighter electricity markets. And so we're seeing quite a bit of volatility, and most of that's been recently to the upside. So another one we certainly want to keep an eye on as we roll through the winter months.
Nick, a question from the audience on copper. Mark is asking about surcharges related to copper. Are you hearing anything about mills adding to surcharges to begin the year in copper?
We are, yeah. So, I mean, given the fact that there are these outages at some major suppliers, we are hearing, in addition to just the fact that the commodity is going higher, we're also hearing that companies are building in surcharges just to account for the fact that there is such a pinch on supply. Yeah, we certainly are. So it's one of those things, unfortunately, where it's almost like it's compounding on top of one another.
Another question about copper from Scott asking, are there copper or tongue twister? Are there copper alternatives in the marketplace?
I mean, aluminum is an alternative over kind of the medium longer term, but from what I understand, a lot of people can't just swap out on their machines one product for the other super quickly. But yeah, typically aluminum is considered to be sort of the copper complement, but there aren't many others other than that, honestly.
Yeah. Okay.
Yeah.
Great.
Excellent.
A lot of copper questions.
Yeah, no joke. I mean, it is a crazy market within the industrial space. It's certainly the one that's got the most momentum, the most, I'd say, tailwinds from a supply demand standpoint, and the demand side of the equation is very much so centered around this AI narrative, which I think is going to continue for years ahead.
All right, you're batting 500.
Batting 500.
Okay.
All right, number 3 is I expected that we were going to see elevated inflation metrics. Now, this is one that somebody could call me out on my eye chart here, but what we're looking at here is going to be the PPI, which is the producer price index in orange. The white line is going to be your consumer price index, and then blue is the personal consumption expenditures. So basically core PCE. And in all 3 cases, they've all, at the very least, in my opinion, leveled out. So I'm saying I'm mostly correct on this for this main reason, which is you could make the argument that leveling out isn't quote unquote elevated. But what I would argue to counter that is they seem to be stabilizing at a level that is in excess of what the Fed said they wanted their target to be. The Fed's been pretty vocal in saying 2% inflation is really where they kind of would guide the target to be. And we're seeing right now all 3 of these indexes right around 3%, which I would say is an elevated level. So, I might be splitting hairs on this one, but I'm going to say I'm correct here. And I think it is also worth noting that in the last year and a half, 2 years, we have seen PPI actually perk back up. It's actually gone from being in negative territory to moving back up towards this 3% level. So I'm going to stick to my guns here and be a little optimistic and say that we have seen inflation stay a little bit higher for longer. The bad news of that means ultimately that prices of our finished goods and services are increasing at a more rapid rate, which is not great news.
I think that's a fair assessment, right? Because it's not elevating, right? It's stabilizing, so it's not elevating. And I mean, to where we were, year or 2 ago at this point, I mean that's a win, I think.
Yeah, fair. That being said, when we look at some of these indices, if we look at like the Bloomberg Commodities Index, which is shown here, this is basically a basket of not just industrial metals, but also precious metals, energy products, so crude oil, natural gas. It's going to have agricultural markets within it. And this is a chart to me that looks fairly bullish from a technical standpoint, basically from a chart standpoint, because it looks like it's got some momentum behind it. Some of that sure is going to be coming from gold. Some of that for sure is going to be coming from copper, which we've shown is breaking out towards record highs on both the COMEX and the LME. But you can see that we really had been in a troughing pattern for the last 2 years. And this does appear to be moving and breaking out a bit to the upside. I sort of drew in this arc down below, which is kind of showing the slow U shape and recovery where we are today. This is one that I think we want to keep a very close eye on, and I'm sure the Fed is going to be keeping a close eye on, because if commodities start to rear their head again, and on a broad basis we see things like energy, we see things like industrial metals really moving back to those 2022 type levels, inflation is going to perk back up, and then we got a little bit of an issue from a Fed policy standpoint. Now on the industrial metals side, so if we just look at the Bloomberg Industrial Metals Subindex, a little bit more of a muted story. Certainly, it seems like momentum is slightly to the upside, but you can see similar story here where since 2022, we've been in mostly a troughing pattern. I've drawn in this red line and this white line. It does look like we're bumping into a little bit of resistance at the red line. But what I would want to note on this chart is this industrial metals index is only comprised of copper, LME aluminum, not Midwest aluminum, so just LME, so the global price of aluminum, zinc and copper, or zinc and nickel. And why that's important is a couple things. One is it doesn't include steel, and right now we'll get to steel here in a little bit, but right now we are seeing steel move a fair amount higher. It's gone up by about $100 in the last 3 months. And then it also doesn't include Midwest premiums, which we'll note here in a little bit. Midwest premiums are at record highs, and when you include that on top of the price of LME aluminum, this chart could look a whole lot different and could in fact look a little more like the Bloomberg Commodities Broad Index and maybe even be breaking out to the upside if you included the actual things people are buying in the industrial metal space. So wanted to make sure that caveat was given, because this chart could look a whole lot different if we included different types or different variations of these industrial metals. Now, so you're probably saying, well, if inflation is elevated at 3% and the Bloomberg Commodities Indexes are starting to perk up a little bit, why in the world does the Fed have 92% odds of a rate cut here in the next 7 days? Well, I would say that the very quick and short answer is the Fed is clearly prioritizing the fact that the jobs data is quickly getting softer. This is looking at the ADP payrolls data, which is basically showing what change on a month-over-month basis is occurring within the goods sector and the services sector. Goods being shown in blue, services in orange. And really, for the last, I'd say 3 or 4 months, we've seen both the services side of the economy and the goods side of the economy seeing layoffs. And, it's obviously a very, it's something we want to be sensitive to, because, job losses, particularly around the holiday season, is not something we want to celebrate in any way. But it certainly looks as though the Fed is prioritizing the fact that these job losses appear to be increasing, and the ability to get rehired is decreasing. And so the Fed is very actively looking like they're going to be cutting again 25 basis points. Oh, right. Yeah.
Sorry. Before you get into that, so we have a 2-part question from one of our
Okay.
from one of our callers, anonymous too. We don't like anonymous. Come on, tell us who you are. The first part you're going to get to later. This person is asking about the deficit in energy production and given the upcoming demand for AI. And I'll just tell you, I'll foreshadow, there's a slide later on that'll address that. The second part I think is good in this segment. Where are we at with historical spread between copper and aluminum? Is there a big spread between pricing of aluminum and copper right now?
There certainly is on an absolute basis. In terms of, I would say copper typically trades at a premium from just a pricing standpoint. In terms of like the ratio, I actually haven't run that math in a little while. So fair question. Okay. I'll make a note to highlight that in an upcoming Cup of Joe, hopefully in the very next one. But my guess would be that copper, just given the fact that over the last 4 years, where at least on the LME side, LME aluminum has come off its record highs by, let's say, 40%. Copper has done nothing but go higher. So I would say the relationship, just thinking out loud, is copper really never had that sell-off that we saw in things like nickel and LME aluminum. Copper really just kind of gradually continued heading higher over the course of the following 3 years. So I would say that relationship did widen out, but I'll put some actual numbers to it, and I'll run the ratios, and we'll chart it out together in the next Cup of Joe.
Sounds good.
All right. So the next prediction was that I predicted nickel to bottom over the course of 2025 and even turn higher. And again, keep in mind that this was done late January, early February. This is the chart of LME nickel over the course of the year. And what happened subsequent to making this prediction is we actually did see nickel prices start to move a little higher. Momentum actually was taking things decently above $7 a pound. What stopped that was the same thing that stopped pretty much all risk assets and the stock market and commodities, which was Liberation Day. You can see the sell-off was extremely swift, extremely painful. And yeah, it was a fierce sell-off. And since then, the market never really got its legs again after that. And for the most part, it's kind of chopped around, I'd say the $6.75 to $7 range for the better part of the year. So I am going to be hard on myself and saying I was wrong, because if you just go from the beginning of the year to where we are right now, just one date versus the other date, the market is down about 2%, which I would argue isn't that much. 2% is not a real big sell-off. It's nothing to cry home about. But if you did an average of the nickel price for the entirety of the year, just a simple average of the prices, you actually get a price that's higher than where we started the year. And I drew that in as the green line. So I'm trying to save myself a little bit, because if you just took the average price, or for instance, if you did a hedge, to lock in your price of nickel at the beginning of the year, you technically would have made money on that hedge, because the average price of nickel over the course of the year was $6.99, which was higher than the $6.80 85 cents that we started the year at. So a little bit of an odd one. This game is tough because we're only doing a bullet point date to a bullet point date. A lot of things happen in the middle. But what I think is worth noting is two things. One is Indonesia continues to gain market share. They continue to ramp up supplies. They're making very small indications that they're trying to crack down on illegal mining and things that are causing environmental issues within the country. But there haven't been any shutdowns or closures of materiality yet. I don't know if we're going to see them with Indonesia, but somewhere we should at some point see some closures of nickel mines. And really this chart depicts why that is, which is to say at current prices, which are just south of $15,000 a metric ton, which is, that's right around, let's call it $6.80 a pound. At current prices, and I've drawn in the green box for you to just walk through it. At current prices, about 50% of the industry, almost half of the industry, is not making money at current prices. So over the short term, nickel miners can do that. They can say, we still want to be in the game. We don't care if we lose, a couple pennies here or there. We just need to keep market share and not close anything up. Over the medium term and the long term, Economics 101 says you shouldn't be operating that business. It's not a viable operation. You should shut in production. And once companies start shutting in some production, I think then we can start to see a better balance in supply demand conditions, and then we can actually see prices move higher. So I don't know if I'm going to double down on this one and kind of make a prediction again for prices to bottom out and move higher. I will say that, even though I said I'm wrong, a 2% down over the course of the year really isn't all that bad. So no, I don't know. Maybe that one's a wash, but I'm going to be hard on myself and say I was wrong on this one. I did expect us to be somewhere in the $7.50 to $8 range, averaging over the course of the year. We didn't get that, but at some point in time, standard economics says we can only grind along the bottom for so long before you actually do get supply rationalization.
And correct me if I'm wrong, but more imports kind of keep domestic prices stable, right? So
on the stainless side, for sure. On finished stainless, that's absolutely the case. And the tariffs are certainly allowing the domestic mills to maintain a little higher pricing than they otherwise would if they didn't have the tariffs in place. There's no doubt about it.
Yeah, and there is more import coming in for stainless than there are other metals. Correct.
I would agree with that. Even right now with the tariffs in place, I probably got to be careful on how I say this, but I would say the mills seem to have the domestic U.S. mills seem to have hiked prices into a range that still kind of leaves the window open for picking your spots on imports. So I don't know whether that's purposeful or not, but yeah, that is an area where we still are seeing imports coming to the United States.
That'll be a big gamble for you in 2026. I think you should go for it. I mean that'll be. That's you're really going to put yourself out on a limb there. I think you should.
We'll have to see how frisky I'm feeling at that time.
Okay, 500 again. 500 going into
500 again. And I'm not feeling real good about this trend right now because my last prediction was that we are going to, and it's the wording is important here, a reduction in Chinese steel exports. And I remember you calling me out and saying this one's going to be a layup, Nick. And I'd say not so fast. Because when we look at Chinese steel exports, this chart's going all the way back to 2011. If we look at Chinese steel exports, not just to the United States, but to the entire world, Chinese steel exports are actually up year over year in 2025. And you can see they're basically at the highest levels since back in 2015-16. And what was 2015-16? That was basically just before the United States put in place our trade policies on protectionism. That was kind of when it all began. So we likely were one of the big buyers back in the 2014 through 2016 timeframe. We then put in place our own duties on steel. They then got larger, and then they got larger again. But China seems to be finding other markets to be exporting their steel. So while you could have at the beginning of the year said, oh yeah, Trump's very anti Chinese steel. Of course they're going to decline. Of course their exports are going to high. Well, It turns out people like cheap steel, and other parts of the world are still consuming it. And the chart kind of tells that story. It's just in a lot of cases not coming to the United States because it's got 500% tariffs on it.
But you're right. It almost seemed like a layup, right? It's like and even with tariffs all over the world, other countries importing that and then trying to resell it or bring it up to the market. It would seem that I'm just fascinated that the
Yeah.
Chinese imports are the highest I'm sorry, exports have been so high.
Yeah,
That's
no,
wow.
I
Yeah.
think I would say part of that's going to be a function of just a weak demand picture within China, where even though, and we talked about this in prior Cup of Joes, even though China does seem to be rationalizing some of their production and some of their overproduction, their numbers are just so big that if they've got to slow down in their economy, I mean, a couple million tons a month is not anything to them. I mean, they've got a billion ton a year steel industry. If you get a 5% slowdown, I mean, that's 50 million tons. It's got to find a home somewhere. And it appears as though it's seeping out into the world economy. And again, like I said, their steel is cheap. When you don't have tariffs on it, their steel is very, very cheap. It's their hot rolled trading with a 4 handle right now. So yeah, if you're trying to find the cheapest steel out there, they're definitely the place to do it. But like you said, some countries are beginning to put up their own walls to protect their own industries, but not all are doing that. And there are certainly still some countries out there who are very obviously, based on this chart, buying that.
Am I
Now,
wrong? Don't they have an annual production limit though on steel?
within China,
Yes.
whether it's officially mandated or not, but yeah, I mean, they probably have the ability to produce up to 1.4 billion tons of steel, but are they going
Yeah.
to? I think they're probably somewhere around a billion.
Yeah. Gotcha.
But yeah, I'd say that's more of a gray area, honestly, whether or not they're sticking to that mandate.
Sure. Makes sense. Yep.
Now, I am going to caveat all of this by saying Chinese steel exports to the United States have certainly come down. And this is maybe the one where we say, well, duh, this is clearly one of the policies that the United States is and has been trying to put in place. I thought this chart was pretty fascinating, though, because when you compare it to the last one, where we saw exports of Chinese steel peaking out at 2015, 2016, I mentioned that a lot of it was coming to the United States. You can see it here in this chart. Back in 2013 through 2016, we were buying lots of steel, baby. We were buying all the cheap stuff. We were bringing it in, by the boatload. And then as soon as the original set of tariffs went into effect in late 2015, and then grew over the following years, those numbers have come off pretty dramatically. And fast forward to the last couple of years, the trend is very much so to the downside. But it's wild to see how drastically large this fall off is, because you're talking about a roughly 90% decline in Chinese steel exports coming to the United States. So the trade policy seems to be working, at least when we look specifically at the Chinese trade routes coming to the United States in steel. So again, wow. I'm going to say I'm wrong, but it kind of depends on when you peel back the onion, which country you're talking about, and over what time frame. Okay. Now, while we're on the topic of steel, certainly want to touch on U.S. prices relative to European prices, which are shown in the blue line. Orange line, like I said, it's the cheapest market out there. That's Chinese steel down at $425 a ton. Here in the U.S., we have very quietly in the last couple of months seen about $100 price move higher. We are seeing Nucor's CSP now up at $920, and certainly it appears as though there's a little bit of a tailwind in prices. Now, from a moat standpoint or a protectionism standpoint, some of this makes sense. Where you look at the price of European steel, $650. If you put $100 on that to get it to the United States, and then you apply a 50% tariff, the cheapest we can get European steel here in the United States is still going to be probably in excess of $1,100 for hot roll. So there is a window here where the domestic mills can probably play with things, taking them a little bit higher. The fact that they aren't doing that kind of tells you that I think the demand picture is still somewhat squishy, and I think corroborating that would be the fact that we are seeing capacity utilization rates here shown in this chart actually moving down over the last couple of months while prices move higher. I think this is, whether it's operational maintenance or just, trying to keep the market better balanced, it does seem as though the mills are they're opting for price over quantity, and they're taking some of that production offline, and have been over the last couple of months. But that being said, I still think we're mostly, and I'm not making a prediction yet for 2026, but I still think we're mostly going to see things be range bound until or unless we get a real strong demand picture, right? There's a little bit of restocking going on right now, a little bit of replenishment as we head into a stronger seasonal period, which is Q1 of 2026. But it doesn't feel like it's not going gangbusters. It doesn't feel like it's got the makings of something that's going to go well in excess of $1,000 a ton on hot roll. Now, I keep pulling up this chart, and I feel bad that I keep showing the stock price of Algoma Steel, but I'm just using it as a proxy, as a reminder to talk about it, because Algoma, we've talked about it in the last few Cup of Joes, but they did recently exit the U.S. market, and they essentially said, we are going to try and seek new markets, new products that we're going to sell within the Canadian market, perhaps even export some of their products into other countries. They got a $500 million loan from their government. But they did recently, again, I just wanted to have this as a placeholder, but they did recently announce that they're going to lay off. And again, we want to be very sympathetic, because we know these are people that many people on this podcast know, individuals over there. They're laying off about 40% of their workforce, which is a pretty drastically large number for a big institution like a steel company like this. So there continue to be struggles there. While I'm on this slide, though, one thing that I think could happen with U.S. markets is there is a price range, and I don't know exactly what it is, but there is a price range for U.S. steel prices where if we start to get to like $950 or $1,000, it wouldn't totally shock me to see both Mexico and Canada kind of re-enter the U.S. market and say, hey, your prices are actually such that even with a 50% tariff, we can at least play in your market again. We can sell some tons into your space. And what I think that does is ultimately keeps a lid on how high domestic steel prices can or should ultimately go over the medium term. So, something to keep an eye out for. Again, I'm not trying to be mean to Algoma and their stock price. It obviously has not done great over the course of this year. But some of that's really out of their hands. It's just trade policy that's making it very difficult for them to operate successfully. Now, so that's through the predictions, which I would kind of say we batted about 500. If we threw an asterisk on some of these, I don't know, maybe you could be a little better than that, but it was a tricky year to predict. And kind of as you noted, you almost have a tale of two pieces of the year, which was you had your January through April where things were pretty optimistic. I think things were people were kind of prepping for something very bullish within the manufacturing space. And then the Liberation Day and confusion around these reciprocal tariffs that didn't really have the equations that people thought they were going to be. That confusion, I really think, just muddled up the market for the next 6-8 months. So you kind of have pre-Liberation Day, post-Liberation Day, and to try and make a prediction on the entirety of the year was going to be very, very, very difficult. This is me making excuses. I'm certainly making excuses for myself, but
I was going to say I'm usually pretty hard on you, but like I agree. I think in spite of, it's a difficult year to go through, and I think there were, like you said, there were two definitive yes and no's. One yes, one no. The rest were kind of part yes, part no, right? And
Agreed.
it's hey, I'll give you a.
Going to give me a C plus?
Yeah, like a 3.5 out of 5. Is that fair? 3.75.
Still not a great score, but we're gonna live to fight on. We're going to do better in 2026, and we're going to have some predictions that are a little more gradable. Something that we can't go through the nuance of trying to make right answers. So
no squishy math, right?
Exactly.
Yeah. Hey,
before I move on from this slide, if I did anything right, it's using holiday terms to throw in some updates. So we've got our miscellaneous update, and obviously,
nice, yes,
exciting.
You're betting 1,000 there.
Yeah, thank you very much. I was feeling very spirited this morning when I was putting together the slides. We can't go Cup of Joe without having the global PMI chart here. I would say the overall theme really is we saw very, very small weakness on a month-over-month basis. Global PMI went from 50.9 down to 50.5. A little bit of that weakness is being felt here within the United States. I would say more so it's being weighed on within the Canadian market and the Mexican market. I promise I'll stop bashing on the Canadians, but they have seen a little bit of incremental softness within those two regions. It just continues to be the case that until or unless there is better cooperation from a trade front, and we have better participation of both of those nations into the United States, I think they're going to continue to tread along in a softer spot. But some of the regions around Europe are actually ticking into the green territory, which is good to see. Indonesia is actually perking up a little bit. India just continues to go gangbusters deep green. They're just they're the bright spot in the global market from a manufacturing standpoint.
There's a question that came in earlier about the PMIs, and I held it for now. Is there any correlation to the countries China is exporting their steel to in the global PMI data? And I'm reading that as like,
Ooh.
yeah, that's a good question.
Yeah, I mean, my first answer is I would say I haven't done the math. I haven't looked at the correlations, but I think there certainly is a case to be made that there are some nations who are kind of just saying we don't really care about what the U.S. is saying with regards to protectionism. It's going to be every man for themselves, and if we can get cheap steel and we can manufacture products cheaper, we're going to do so. I would say there definitely are some emerging markets that are likely doing that, which does kind of buck the trend against the Western policies that we're trying to put in place. But I do think that that's occurring. But I don't have the exact correlation on saying that their PMIs are doing phenomenally better. Like in the case of India, India's PMIs are quite strong right now. India, in some commodities like energy, I would say they've still for the most part been buying cheap Russian energy and natural, like crude oil, natural gas, and there they've kind of bucked the trend of the West and said we don't care, we want cheap oil. But in areas where India can be self-sufficient, for instance, steel, where they have their own local steel industry, those are areas where they're actually, clamping down a little bit and protecting their local operations. So I'd say it just depends on which countries have what productive assets within their own economy.
And as far as you blaming Canada, Nick's a big fan of South Park. Was that the song? Blame
That's
Canada.
right. That's their flappy heads. Yep,
yes,
that's right. Real quick note on the consumer. We're heading into holiday season, or maybe we're already in the thick of holiday season. This is more just anecdotal than anything, but it is worth noting. Despite all the headlines about the weakening consumer and all of the I guess the layoffs, which is certainly a weakening trend, we are still seeing some strength in a couple key categories. One of which is going to be people flying in airplanes. This goes all the way back to pre-COVID because I wanted to show some of the data where we would have been trending before we had our lockdowns. But last Sunday, which would be the Sunday after Thanksgiving, which is typically a very, very large travel day, obviously, we did have record high TSA checkpoint data. So this is the number of flight passengers who are going through TSA checkpoints, and it hit an all-time record high, which tells you at least for some subset of people, which looks like just over 3 million people on that day, are still traveling, are still freely moving around the country, moving around the world, which is a sign of a healthy consumer. We are also hearing anecdotes of like the holiday season shopping trends on a year-over-year basis up, figures like 8-9%, it's a pretty strong growth figure. Now, some of that is going to be inflation that's feeding into that growth, which isn't a good thing, but inflation is not 9%. So some of that is actual, spending growth. So the consumer still seems to be a bit alive and well, I guess is the point of these pieces of data.
Certainly seems that way.
Now, we touched on all the other metals, but we didn't touch on aluminum yet. So I want to spend a little bit of time on aluminum because we're obviously in very rare air and we're in pretty unique times for aluminum. The white line is going to be the London Metal Exchange price, which we're at the higher end of the recent range, which is right around $1.30. So we are certainly elevated. I think copper moving to record highs is trickling through to a slightly more bullish picture for aluminum. Whether that's true people switching from one to the other, or whether it's just sort of saying if copper's doing well, aluminum should also do well because they go into a lot of the same things. That trade sometimes does happen, but you can see very clearly in this chart, LME prices are not anywhere near where they would have been back in March of 2022 when we had record high prices. We're still off by about 50 cents. But when you include the Midwest premium, which is inclusive of the tariffs, which again are 50%, the Midwest transaction price, or in other words, the price to buy aluminum here in America, is at record high prices. We're within a couple pennies of that all-time record high. So, certainly want to be sensitive to this topic because it has been wildly inflationary. And I guess the question is, where do we stop? Do we keep going higher from here? Well, my take is, and this is corroborated by some outside research, which is Harbor Aluminum. They put out some great paid for subscription data, but just one quick thing they put out a few hours ago was that they're basically noting the fact that even with 50% tariffs, Midwest transaction prices are at such a high level that imports from pretty much every region of the world, including Canada, but also, the Middle East, obviously, anybody who's got cheaper energy supplies, they're able to deliver both primary aluminum, so aluminum ingot, as well as common alloy aluminum into the United States And it sounds like there's even a decent arbitrage there, meaning they can do so and they can have a profit in doing so. So that's even with a 50% tariff. So we've basically cleared that threshold where prices have gone so high that even with the tariff, we're still the market that's the most attractive. And that's kind of what the headline of this piece says. So my gut kind of says that that's going to help to keep a lid on things, just because I think traders out there are going to see that and they're going to say, absolutely, we should make the $100 or $200 a metric ton that we can make just by changing up trade flows, moving it to the United States, and helping to better balance domestic markets. And that's even with the tariff still fully in place. Now, we talked about this slide last month, and I want to highlight it for a couple of reasons. One is over on the left-hand side, you can see all the regions and the amounts that different countries import into the United States, or historically had imported into the United States. We are a net importer of primary aluminum here in the U.S. But the question is, will the U.S., with these record high prices, will they begin to flip on new productive capacity? The chart on the right basically says no. The chart on the right essentially says we would need significantly higher pricing for the price of aluminum. We would also likely need significantly lower power costs to make this work. So until or unless one of those things happen, either aluminum prices go substantially higher, which jury's still out on that, or power prices go substantially lower, which I don't feel is the trend at the moment, then I don't think it economically makes a whole lot of sense for domestic producers to ramp up. So I guess kind of, again, I'll reiterate, I think the steel tariffs were quite effective in incentivizing new production here in the United States. And we have seen new productive capacity over the last several years, and it has created a moat. In aluminum, only a few key players, basically Century Aluminum and Alcoa's American operations, are really benefiting from this increase in Midwest premiums. Everybody else, it's really kind of just a pass through, or if you're an end user of aluminum, it's an added cost. The idea of new production coming online is seemingly going to be a pretty far-fetched one, and it seems like it's going to be even more far-fetched given what we're calling the AI or data center power struggle. Mike and I came across an article just yesterday, in the last couple of days, that basically was saying that the relationship goes this way. The hyperscalers, so Meta, Google, NVIDIA, to build these data centers, to get them operating, to do all the compute power to run AI models, they need more aluminum to build these structures. So that's one of the items that it needs. So they go to the aluminum smelters, they say, hey, make more aluminum. The aluminum smelters then say, okay, if we want to make more, we have to secure more power, because aluminum is an extremely power intensive product. When they go to try and secure their power, what they find out is those same data centers are also the ones who are bidding up the price of electricity, thus making it uneconomic for that domestic smelter to ramp up operations. So it's this weird, cynical cycle of the same companies who are trying to help the data centers can't ramp up more production because the person they're trying to supply with aluminum is outbidding them on electricity, which is the most component to making aluminum. And the number, to put numbers around it, we're hearing that aluminum smelters kind of need a fixed cost of somewhere around $30 to $40 a megawatt hour in order to profitably make aluminum at current prices. Data centers are paying more than double that. They're paying $100 a megawatt hour for their electricity. So at $100 a megawatt hour, I don't want to be too bold on this comment, but there probably ain't going to be any more smelters coming online in America with power prices being that tight. So somebody was going to ask a question earlier about, the power usage and things like that. It's a real thing. And I would say it is spilling into the metals market because it's disallowing or making it uneconomic for new production to come online here within America. So it's a very perverse circular reference that unfortunately what it likely means is if these data centers need more aluminum, and I can tell you based on some of the business we've been seeing, they need more aluminum and they need a lot more copper. A lot of that's going to be coming from foreign sources, not domestic sources. And it's really because of this power struggle that we hopefully detailed decently well.
There was something in that article that stood out to me. I think it was the Aluminum Association that said if a new domestic smelter were built today, it would require the same amount of electricity as like a city the size of like Boston. I mean, that's a
Yeah.
lot of electricity. So
It's staggering. It's truly the reason why some of these smelters are built in places like Iceland, where they have geothermal power. They effectively have free
yeah,
power, because if you can do that, your cost of producing it's going to drop dramatically. It's why basically before you would ever consider setting up a smelter, you absolutely have to negotiate with some local government to say, either give me a subsidy or guarantee me some fixed cost on my power.
yeah.
These things will get fixed in the medium and long term. Things like nuclear will help with that, but in the short term, there's absolutely a push pull effect within data center and then the resources that are supplying it. Last but not least, we are going to go through our Cup of Joe wish list, and I guess you're going to get a little bit of a sneak peek of what one of them is going to be. But Mike, I'll kick it over to you. You can go through these.
Sure. Yeah. So Nick and I were talking this morning. Okay, how are we going to wrap this one up, right? And Nick's going to have his predictions come January, but everybody has a wish list this time of year, and we thought, okay, let's put together a wish list for the metals and manufacturing, and then you'll see the image down below. We'll have a little fun with the things we like to talk about. And the first one is, for manufacturing, let's bring a PMI that stays above 50 long enough for it to feel real. And I think that speaks to the hovering around 50, which is the kind of the midpoint, right? To say if it's contracting or expanding.
Yeah.
And let's get it above 50 for some consecutive months here.
Yeah, it's an interesting one, and I can certainly say that our investors would be appreciative of that too if we start to see real demand, consistent demand, pushing, not just the PMIs, but also the real consumption data somewhere well north of 50. I've gotten the question before, what would a PMI need to look like for a consistent period to say that demand is returning? And I often answer that question by saying something in the realm of like 52 and a half or above for a 3 to 6 month stretch is really what we need to start to see to really get some momentum behind the manufacturing space here within America. So I think that's a great one. I think it's a very timely one. I think it's one that a lot of industry pundits are watching for. And we've gotten a couple head fakes. I talked about pre-Liberation Day, January, February, March. We were starting to see that. It almost started. We were starting to feel like animal spirits within the manufacturing world that, there was this new blossoming of the space, and we were going to have many good years to come. And then truly Liberation Day kind of slammed the brakes on it. And we never really quite got back to it on a broad basis across the economy.
Yep. Second one, we started talking about steel, right? And I think it speaks to what you just described in the previous point, Nick. Let's get a real demand uptick here to support the current price trend. Of course, without a flood of imports. And I think we talk a lot about data centers, and that's probably what's fueling around a lot of the demand right now. But let's see if we can get demand uptick from elsewhere to kind of support that trend.
Yeah, and I think the without a flood of imports. I think the without a flood of imports is already taking place. I do think that the tariffs are helping to create a moat. Some of those imports are still absolutely necessary, either products that we don't make here or whatever it may be. But I think what we'd want to see as a trend throughout the course of next year. We talked about capacity utilization currently being around 75% right now. I think what we'd want to see to say that demand is actually returning is not just stable or higher prices, which we are seeing stable and slightly higher prices right now, which is a little bit of a restocking rally. But I think we'd also wanted to see that paired up with better utilization rates where, steel producers here in America and North America are actually producing somewhere north of 80%. And we have, stable pricing. That would really be what I would look to say, okay, the demand picture is actually recovering. We're seeing a broad-based rally in many of these end markets. And I think that those are the types of factors we'll keep an eye open for over the course of 2026 to hopefully corroborate that.
Aluminum, we talked about some new domestic tons coming online faster in 2026 and no fires. That's to speak to not one, but two fires at Novelis in New York over the past 3 months, right? That have really kind of put a damper on things, and we hope I was well there. But aluminum's been the headline all year, and it just seems that to speak, and even what the example you just gave, right, about the data centers, we need more tons coming online faster this year. in the
That's
coming
right.
year.
And we will also, in addition to, the restarts of post-fire, I think we will also have some ramp ups from aluminum dynamics down south as well, which should help to better supply the common alloy markets. And then the last two, these ones are fun ones. And you obviously got the preview from the picture already. We apologize for that. But, quick backstory on this. I went to one of the AI systems and I said, put an Ohio State player next to a Chicago Bears player and have them both holding their respective trophies. And this is the image that it came back with, which is kind of horrifying, which is a trophy that looks like it's got a head of an Ohio State player on top of the trophy.
Hunting. Yeah.
I didn't have a whole lot of time because I was putting this together sort of last minute. So I'm like, we're going with this, but it sort of gets the point across, but not quite as effectively as I was hoping. But
it's terrifying. Actually,
it is terrifying. But we're hoping for a Bears Super Bowl. They're certainly trending towards the playoffs, and then anything can happen, right?
Yeah, 9-3 here in December in first place, number one seed in the NFC. We were talking today earlier, Nick and I, like, why not? Why not go all the way? That you just got to ride it sometimes because you never know what year is going to bring. I mean, they're not Ohio State, who's going to be the national champ contention conversation every year. The Bears get this about once a decade, so let's make it stick this time.
I love it, and it's way overdue as well for the Bears.
Yeah,
so very happy for you.
Yeah, tired of talking about 85. But
the Buckeyes got a big game this weekend against the Indiana Hoosiers in the Big Ten championship game. So hopefully everybody tunes in for that one on Saturday night.
Well, you finally beat Michigan. It's been a few years, right?
It's about time. My goodness.
Yeah. Well, we got time for a few questions. You good with that, Nick?
I'm good with that.
We irritated a few Detroit fans, by the way. They're booing us, so sorry.
both for the Lions and for
that's right. Yes, that's right. Yeah, double whammy there. Question about stainless. What's driving price increases? Because there's roughly 9% up year to date, yet nickel's down. So what is behind that?
Yeah, so a little bit of it. Well, the first thing I would say, which is the elephant in the room, is going to be tariffs. Tariffs have allowed the domestic stainless industry to take base prices higher. So that is going to be reflected on the all-in price of stainless itself. On the commodity elements that go into it, obviously it depends on the grade, but you've got nickel going into many of the grades. You've got molybdenum going into something like a 316. You've got chrome, you have scrap. Yeah, sure. On the commodity side, nickel's been mostly stable. As I mentioned, it is slightly down, but it's down 2% over the course of the year. The average price over the course of the year is actually slightly up, as we mentioned in that slide. So I would say nickel's really a non-event. It's been very flat. Chrome's been pretty darn flat as well, as has scrap. We've seen a little bit of an uplift in molybdenum. So if you're buying 316, that would have seen a little bit of a price increase over the course of this year. Some of that's going to be stemming from, because I don't know if many know this, but when you mine for molybdenum, most often that's just a byproduct of copper mining. So where copper goes and where copper prices go, ultimately there's a little bit of a knock-on effect to molybdenum. So molybdenum has actually had a decently strong year that lifted 316 prices ever so slightly. Most of the other commodity elements that go into stainless have been pretty flat. So I don't think that's where your volatility is mostly coming from. It's more so just coming from the tariffs. Short answer.
Makes sense. Okay. And one more over to the steel. Are you seeing a bullwhip effect on pricing because the made and melted in U.S. direction that people are taking?
I love the bullwhip reference. I think a little bit. Yeah, I think a little bit. I think, if you go back to that original table that I showed, hopefully this viewer was tuning in while I was muddling through all my screens and signing myself off. But the very first screen that I showed, just the complexity of going out and sourcing something, whether it's a finished product or whether it's a commodity, is just getting so complex and such a headache that I do think there is an effect that's having on consumers and probably service centers and traders as well, where they're just saying, I don't want to deal with all the red tape. I don't want to hire a trade lawyer to go through all of this detail to figure out how this all works. I might just pay an extra $50, $60 to just source domestically. And yeah, I do think that is happening just from a pain in the butt standpoint. In addition to, in many cases in steel, there is still an arbitrage, meaning the price to consume steel from a domestic mill is in most cases still going to be cheaper than going out buying foreign, paying the tariff and bringing it in.
Okay. And there's kind of a request. Maybe we can get it into next episode from Mike. Um, he's
Is it
saying
don't log myself out?
yeah, yeah.
Yeah.
Take Zoom classes, guys.
Learn
That's
how
what
to
he's saying.
learn how to
Yeah.
Zoom.
Yes.
Yeah.
Um, on your export slide, can you break out stainless steel from the other alloys? That might be, I
I
don't
will
know.
try. I will try.
Yeah.
The reason why I say I will try is I know for a fact that with importation into the United States, I do know that the U.S. has a pretty good system within our census data that our customs data that allows us to segment a lot of these things, and so we can get pretty granular on things coming into the U.S. For things coming out of China, I don't want to overpromise because some of that is just very high level headline data. I don't know if we have the more line item type intricacies, but certainly we can give that a try. I'll make a note to dive into that.
While we're at it, I kind of held this one on the side, not sure if we are able to get to it, but have you, someone's asking about, do you know what tungsten carbide is?
I do know what tungsten carbide is.
Okay. They're
I've
asking
actually
about the volatility, and I didn't know if that would put you on the spot because I don't know if you knew anything about that.
I don't. I know its application. I know that they make rings out of it. I know it's very durable. I would guess just based on its durability, it's probably going into tool steel, but I am not an expert in tool steel, and I don't even want to pretend to be an expert in that space.
Makes sense. Yeah, I figured. Yeah.
I'm going to leave it there. I'm going to leave it there.
Chris, we got to it. Sorry. Oh, great stuff. We went over this time, but I think this is jam-packed. Good stuff as always, and I think it shows what a year it was. I think to what we said earlier, you think it was a hard year to predict, but hopefully over the past 12 months we've kept it fun and we've helped guide it along the way. But Nick, I'll give you some closing thoughts here for the year.
Yeah, I guess I'll just kind of wrap up by saying the rules of the game, at least while they are complex, they're at least better known now. And I think just knowing the rules and then knowing how to navigate, hopefully will get easier in the months ahead. And yeah, I guess the last hope to the wish list kind of feeds into all the rest of them, which is hopefully that means better predictability, better security around supply chains, and thus better ability to produce things ideally here in North America. But no, we're in the thick of holiday season. I hope everybody has a healthy, safe one and a fun one, and enjoy these slower times with the family. And we look forward to picking this up in 2026. It's going to be a fun one.
Yeah, echo that. Thanks, Nick. Thanks, everyone.
Excellent.
We'll see you
Thank
next month.